Happy Thursday out there, Team 42. It's your skipper here at Darius, our macro minute for Thursday, October 26th, 2023. As always, we start with the executive summary from today's leadoff morning note. As always, if you want the analysis supporting these conclusions or what to actually do about the conclusions in your portfolio, you need to be a client of 42 Macro. So we'll start with number one. Meta is down about 3% today and becomes the latest mega cap growth company. Investors with guidance saying it was at the whim of an uncertain economic environment. This is a friendly reminder. Meta is up about 150% year to date, only down about 9% from its 52-week high, and has a buy, hold, sell ratio of 60 buys, 70 holds, and only 2 sells among Wall Street analysts. Yikes. From our vantage point, number two, the primary source of uncertainty about the near-term economic environment is whether real GDP growth will cool modestly or slow sharply from the booming 4.9% pace it recorded in Q3, which is the highest since 4Q 2021. Insert bow here for the resilient U.S. economy theme. Number three, and actually, obviously, all jokes aside, when we take, quote unquote, victories like that, it's not to celebrate myself as an analyst or our firm. It's to celebrate our process. I think we have among the best macro risk management processes on global Wall Street. Certainly on the sell side, they're obviously plenty better on the buy side. But in terms of when we celebrate these calls, it's say we got something right that most investors got wrong, which we did, by the way, in terms of helping investors understand one half of that transitory Goldilocks theme we authored back in January with our friend Bob Elliott over at Limited Funds, but also understanding that resiliency for the belt that we half of the year, and it's all the function of the same quantitative risk management signals day after day after day, analyzing the same economic data sets month after month after month after month after month, and repeating those same boring processes so that we can give ourselves the best possibility to help our clients make and save money on a consistent basis. We are going to get plenty of stuff wrong. We get plenty of stuff wrong, but we've had a hell of a year. Continue to execute the same processes that have contributed to us having a hell of a year. Getting back to summary, number three, what's most concerning about the recent transition to inflation is the starting point of performance and valuation. So the Qs and Apple are still up about 31% year to date. Microsoft and Google are still up about 42% year to date. Amazon's still up about 45% year to date. Tesla's up 70% year to date, and Nvidia is still up 86% year to date. We know the non-easy macro quote unquote gurus largely missed the first half bull run in stocks, but that's and the second half of both path and bonds. But that's a lot of performance to give back if loan-only mutual fund managers get spooked into protecting performance and/or CTA systems start booking gains in NASDAQ futures at an accelerated pace. Our quantitative risk management signals, the same ones we refresh 6 days a week for 42 macro clients, the risk of a rush to lock in year-to-date gains by fund managers and/or a cascade out of the mega cap growth factor by CTAs continues to rise rapidly. Bloomberg here will get cross-asset performance and wrap it up. So we'll start with the S&P or U.S. equities down about 3% week over week, being led lower by consumer communication services down about 6%. And you also have energy down about 5%. Bucking that trend up here, you got utilities up 1%. Continues to be the name of the game late in the business cycle. In terms of factor performance, factor dispersion is very wide. You got low beta basically flat week over week, whereas high beta is down 5% week over week. So very much in line with the risk off market regime that we called out back at the beginning of this month. In terms of geographic performance, down 3% in terms of S&P. Down India's leading the way to the downside at 3.5%. You also have Canada minus 3%, kind of dragging U.S. equity indices. So it's kind of an America-focused theme here. When you look at it to the downside in geographic performance, with the exception of India, obviously. In terms of, I actually don't have it on the proper duration here, so we'll just we'll allow that to change real quick. All right, Bloomberg, there you go. All right, so in terms of fixed income performance, we're up 0.6% week over week in terms of the core ag. Very limited dispersion. TLT is kind of leading to the upside, up 1.2% week over week. LQD, another long duration exposure, up 1%. In terms of currency performance, we're up 0.7%. in terms of the U.S. dollar. Swiss franc finally giving up the ghost, have been stalwart amongst global currencies amid the geopolitical tensions, conflict in the Middle East. We also have the Canadian dollar down 0.9% week over week. In terms of commodities are down 2.3% week over week, being led by energy. Crude oil down 5% week over week. Bucking that trend is uranium up 2%. And then lastly, we're starting to see crypto give back the gains here a little bit at the margins. Points up 19% week over week, and all other digital assets. And then lastly, transitioning to my Lombo dashboard, we got an overbought signal here in the dollar. So dollar's been very anti-correlated or inverse to assets. So maybe a good spot to think about covering shorts and some equity and exposures. Also, and that makes a decent amount of sense. We're also getting to a near oversold condition in the S&P, but this is more of a short covering exercise rather than a buy the dip exercise, given the bearish medium and short-term price momentum there. And that's about it. We'll wrap it up there. So Darius Dale presenting our macro minute for Thursday, October 26, 2023. Best of luck out there today. Have a great day. We'll catch you back here tomorrow. Cheers.